Hello, everyone, and welcome to the November session of our ongoing webinar series. This one is called Year-End Tax Planning Strategies for Financial Success. My name is Tom Bittinger. I'm with the content marketing team here at Wealth Enhancement. And before we get started, I just want to go over a few housekeeping items. As always, there will be a Q&A session at the end of the presentation, so feel free to submit your questions using the questions pane on the GoToWebinar menu. And we're going to get to as many of them as we can. And then again, as always, we are recording today's session. So we will make the replay available to you in the coming days, either via email or on our YouTube channel. So be sure to check that out as well. Jumping into things, today's presenter, I'm very pleased to introduce Angelica Gumabon. She is a tax director here at our Orcutt, California office. She's a leader of Wealth Enhancement and Tax and Consulting Services West Coast team. And we've got a lot of people here, a lot of interesting information to get into. So Angelica, take it away.
Thank you, Tom. Thank you, everybody, for taking the time to join me today as we go over a really important topic, year-end tax planning. So as a tax advisor in my line of work, I often encounter this belief from clients that, tax planning, it only makes sense if your income has increased significantly over the past few years. But that's not certainly a reason why you revisit your tax planning. It's good for high income earners, your year-end tax planning. It's the ideal way to help look at the bigger picture and see what we can do to reduce your tax liabilities and minimize your tax bill over the year. But year-end tax planning is also very important if your income has gone down. So if that's the case for you, strategic planning can really help mitigate your losses so you can preserve your savings and potentially take advantage of your lower income to rebalance your portfolio. So either way, getting into that habit of reviewing your tax situation at the end of the year, it's really going to enhance your financial success as your earnings shift over time. So that's why I'd like to cover some amazing strategies here. So there's 3 tax optimization strategies that I'll cover, depending on whether your income is higher or lower than expected this year. All right, so before we dive in, I want to take a quick moment to review the basics. So as I'm sure you know, tax planning for individuals, it generally starts with understanding your tax bracket. So it's basically the income range that determines your percentage of income you'll owe in taxes. So in this range, it varies. It depends on whether you file your taxes as a single person, a married filing joint with your spouse, maybe even if you're married filing separate, or as head of household. So it just varies depending on your income level for that year and depending on your filing status. So to give you an example of how this works, if you take a look at the 2024 tax brackets here, you can see for a single filer in 2024, the lowest tax bracket is 10% on incomes under 11,600, while the highest tax bracket is 37% on income over 609,351. So for married couples filing jointly, the 10% tax bracket actually applies to income under 23,200, while the 37% tax bracket, it applies to income over that 731,201. So these percentages, they really make a huge difference when it comes to calculating your annual tax bill. So it really explains why tax brackets are so important and why it's critical to review your tax plan each year, particularly if your tax bracket changes. So for example, a person in the 12% bracket, and then next thing you know, they're hitting 22%. It's a nice big jump. So we do watch for that at year-end planning. So really, no matter what tax bracket you fall into this year, The key to effective tax planning, it's going to involve leveraging your tax incentives and your deductions, what's available to you under the current tax code. So we'll have to carefully analyze your financial situation. We'll look into your income, your expenses, investments, and deductions. We can help you really identify what opportunities there are for tax savings and really just structure your investments in a tax efficient manner. So today we're going to cover some very high level strategies. And again, I want to stress that it's very high level. So you'll hear some topics thrown out. So you'll want to make a note there for yourself or to discuss with either your financial advisor or tax advisor. But again, high level strategies, depending on if your income for the year is higher or lower than normal. We'll also take a look at strategies you can employ if you've earned a bonus and got equity inside of a company or received some other form of non-cash compensation this year. So we'll get started. So strategies that you'll utilize if your income is higher than normal this year. Really, if you find yourself in a higher tax bracket for 2024, one of the best ways to reduce the taxes you'll owe is by maximizing your tax deferred accounts. So your traditional IRAs, your 401ks, your HSAs. This has a range of benefits. So first, your contributions to these type of accounts aren't taxed. And so that amount you contribute into the account is tax deductible on your tax returns. So that means by maximizing your contributions to these accounts, you're basically able to lower your taxable income sufficiently to fall into hopefully a lower tax bracket. As an added benefit, when you maximize your contributions, you're also putting more solid footing on your retirement. And so I like to stress that with clients particularly, because at first, especially if you're looking at cash flow, depending on your situation, maximizing some of these accounts may not be the greatest position, depending on your lifestyle and income flow and whatnot. But really start letting them think about things long term. So again, setting that solid footing for retirement ahead. So although you're paying tax on money you withdraw once you retire, chances are you're likely going to be in a lower tax bracket at that point. So that's a good thing. So rather than paying tax on the income today while you're in a higher tax bracket, you can actually defer your taxes to a later year when you're likely going to be in a lower tax bracket. So as you can see from the chart that's in front of you, each of these accounts have a different annual contribution limit. And so there's a column there labeled catch-up contribution limit. So if you are over 50 years old, you can make a catch-up contribution. So doing so, it'll further reduce your tax bill over the year. And really, one of the best ways to proceed, I just like to stress this again, is just make sure you're working with your financial advisor and your tax advisor to assess how much contribution is available to you for these various accounts. You definitely don't want to put an excess into them because that could create some other taxable issues. And you want to make sure that you determine how much you can comfortably contribute for the year. Because again, everybody's situation is different, and cash flow and the means to contribute to these kind of accounts just depends for everybody. So another way to reduce your taxable income before the end of the year is by doing something that's called tax loss harvesting. So at a basic level, tax loss harvesting allows you to offset some of your realized capital gains with capital losses, so they can net against each other. So for instance, if you sold investments at a loss, you can use those losses to reduce the capital gains tax that you would have otherwise owed on investments that you sold at a profit. So even if you don't realize any capital gains this year, it's important to note that you can still use tax loss harvesting to offset up to $3,000 of your ordinary income. So $3,000 is a threshold for the amount of capital losses after it nets out with all your capital gains. And if there is none, no capital gains. And again, $3,000 is that flat limit. What you don't end up utilizing for that year is then carried forward. So you can carry forward any investment losses you realize this year to offset gains in the future. So this partly is what makes tax loss harvesting a really good long-term strategy for our high-income earners. The third strategy is if your income is higher than normal this year, it involves taking steps to accelerate your available tax deductions. So again, this webinar is very high level. This slide in front of you is specifically going to focus on accelerating tax deductions related to charity. But there are other tax deductions available depending on your situation. And I do want to stress again, this is very high level, not mentioned in detail here. But if you do have a business or other rental properties and things of that nature, there are tax deductions that you can take advantage of to accelerate and help reduce your taxable income. But again, we'll revert back. As a taxpayer, there's a variety of different deductions. If you're an individual, one of the underutilized type of deductions that I would mention is donor advised funds. So the first, when you contribute to a donor advised fund or a DAF, it triggers an immediate tax deduction if you use this avenue. It allows you to direct the charity on how you spend your donation, how you want them to spend the donation after the money has had time to grow in the fund. The next strategy is to optimize your charitable donations. So if you are itemizing your deductions and not taking a standard deduction. So for instance, by donating appreciated assets to a charity of your choice, so donating your stock, your different investments, rather than making a cash donation, you can generally avoid paying capital gains tax while still making a real world impact. And finally, starting at the age of 70 and a half, you can route distributions from your retirement accounts directly to a qualified charity. So using a qualified charitable distribution, QCD. So this strategy can help retirees keep their income down, which can be particularly helpful once your required minimum distributions, your RMD, once it kicks in at age 73. So finally, you'll want to, this is not part of the 3 strategies if your income is higher than normal in the year, but I do want to mention this. You'll want to try to avoid this net investment income tax. It's something to consider when your income is a lot higher. It is a 3.8% tax on your investment earnings over your modified adjusted gross income threshold. So for those high income earners and single filer in 2024, that threshold is 200,000, and a married filing joint taxpayer is 250,000. So now that we've taken a look at the strategies if your income was higher than normal, we're going to move on and look at strategies if your income is lower than normal. So these are some tactics you'll want to deploy. So here we'll be looking at 3 different strategies. The first being deferring your tax deductions, so saving it in until a future year. The second is rebalancing your portfolio. And then the third, which I see very, very often, is considering a Roth conversion. So with the first strategy, this particular slide, and again, very high level, we're going to be looking at deferring your itemized deductions. So the idea here is to avoid taking tax deductions that you don't need. So for example, I get clients all the time asking if they should donate a certain amount to charity as one thing. But that charity amount, that what they're trying to accomplish, is not going to get them over that standard deduction amount. So I always tell them to kind of hold off and wait. But the idea here, again, avoid taking deductions you don't need. So when you file your taxes, you'll still claim that standard deduction. If your income is lower this year, it may make sense to push off those deductions you can control until a later year when your income is higher, so you can actually make them count. The second strategy to consider during a lower income year is end of year portfolio rebalancing. So when we talk about balanced portfolio, what we're really referring to is the mix of different asset classes within your investment portfolio. So typically, the balance will reflect your personal investment goals and your risk tolerance. And sometimes, however, based on market performance, your portfolio balance can become skewed. So it results in an asset mix that doesn't quite match your risk tolerance. So rebalancing involves bringing your portfolio back to their ideal ratio, which entails buying and selling some of your assets. So if you do sell during a high income year, those additional gains that you earn, it could potentially put you into a higher tax bracket, and again, also result in additional capital gains tax. So for this reason, low income years present a really good opportunity to do portfolio rebalancing. So to understand how this works in practice, if you take a look at the table here, you'll see that if you're a single filer whose income fell below $47,025 this year, you can potentially sell some of your assets without actually owing any capital gains tax at all. So you'll be in that 0% long-term capital gain rate. And if you're married filing joint, you would still have a 0% capital gain tax if your income is under $94,050. And then finally, when your income is lower than normal, this could really be a great opportunity to consider a Roth conversion. So simply put, a Roth conversion, it involves transferring retirement funds from a traditional IRA or a 401k into a Roth account. So one of the main advantages of holding funds in a Roth account is that you don't pay taxes when you finally withdraw the funds during retirement. So that's a good thing. On the flip side though, it does mean that you have to pay taxes up front. So there's an immediate tax impact. When you move your money from a tax-deferred retirement account, into a Roth account, there's those pros and cons of doing so. So again, in a lower income year, this is something to consider. But this is one of the reasons why it makes sense to consider executing this Roth conversion. Again, a lower income year, so that you pay less in taxes to move the funds. But again, speak with your financial advisor and tax advisor if this is right for you. So to understand how a Roth conversion might work in practice, if you look at this example here, so let's say you typically earn $110,000 a year and you're a single filer. So that'll put you into the 24% bracket. But this year, let's say your income fell to $90,000. Maybe you got a new job, didn't quite pay much, or whatever the case may be. It does put you into that lower 22% bracket. So in this instance, technically you can transfer about 10,000, rounding 10,000 into your traditional accounts into a Roth account. So you could do a Roth conversion in that amount while still remaining in that 22% tax bracket, since you only start beginning to pay that 24% tax if your income is over $100,525. So word of caution again, there's potential advantages of doing a Roth conversion, but this strategy is not right for everybody. So again, just want to stress that you want to make sure it makes the most sense for you, and to speak with your financial advisor and your tax advisor before you deploy this. The final end of year tax planning strategy we'll cover applies if you've received income from a bonus, equity, or other non-cash forms of compensation. So again, there are numerous approaches you might be able to take, but we'll look at three primary ones specifically. So the first is going to be about creating a multi-year plan to balance the tax impact of exercising stock options. The second is using a net unrealized appreciation, or NUA strategy, if you receive company stock from your employer. And then the third is deferring your bonuses and your income during higher earning years. So we'll take a look at the first strategy, which applies if you've been issued stock options. So in this case, it's important to know what type of option you've been issued. These will either be statutory stock options, incentive stock options, stocks from an employee stock purchase plan, or it can be a non-qualified stock option. So these two classes of options have different tax implications. So with a statutory stock option, you can generally qualify for for a more favorable long-term capital gain rate if you hold your stock without selling it for a prescribed amount of time. But with a non-qualified stock option, the gain that you end up earning on the sale of your options, those will be taxable as regular ordinary income, which attracts a higher tax rate. So for this reason, it's important to create a multi-year plan to balance that cash flow and the tax implications associated with exercising these options over time. So during a high income year, you may not want to exercise a non-qualified stock option if you don't have to. Conversely, if it's a lower income year, it may be a good time to exercise these options if you can. The second strategy we're going to cover involves the tax treatment that applies to company stock that your employer might have issued to you, say through an employee stock purchase plan or 401k. So for tax purposes, these shares have two parts. It's the cost basis, or what you paid for the stock, and the appreciation, so which is how much stock has risen in value, how much the stock has risen in value since you purchased it. Normally distributions from a 401k are taxed as regular income. So it means you pay whatever tax rate you fall into based on your tax bracket. But if you follow the NUA rules, you'll still pay your regular tax on the cost basis of your shares, but you may be able to pay the more favorable capital gains rates on your stock's appreciation. So there's a critical note here, specifically with NUAs. An NUA can only take place after a qualifying event. So either your over 59 and a half, or you're no longer working with your employer, or you've just retired. So in this case, again, speak with your financial advisor, tax advisor to see if this strategy will work for you. And finally, the final tax planning approach we'll cover today is something called a deferred compensation strategy. So this benefit is typically offered to top employees who are in a higher tax bracket. So in essence, if you defer a portion of your income or your bonuses to a future year, your tax bracket ideally, hopefully, will be lower at that point. So if your employer does not have a deferred compensation plan in place, but you think it might benefit you, it may be worthwhile to speak with your employer about setting one up. On the flip side, there's some risks associated with deferring your compensation. So another area where it's suggested that you speak with your financial advisor and tax advisor first to make sure that this strategy makes sense for you. All right. So we've covered a lot of ground here. Again, it was very high level. We really only scratched the surface of everything. So with that said, I hope I've given you some new things to think about with year-end planning and how to tax efficiently structure your finances and investments in both a higher income and a lower income year. If you'd like to delve deeper into any of these topics, please don't hesitate. Check out our blog, reach out to your financial or tax advisor. Tax planning is a very complex and nuanced process. So working with an experienced professional can really help you take advantage of all the opportunities that are available to you. So thank you again, everybody. Tom, I'll send it back your way.
All right, yeah, looks like we got a few questions here. First one, can you take a consolidated RMD from one IRA account sufficient to cover the RMDs for all your other IRAs? Or does each IRA require its own RMD withdrawal annually?
Yeah, so that's a great question. It comes up quite frequently from clients. So just in general, if you have more than one IRA, you need to calculate the RMD for each IRA separately every year. But you can aggregate your RMD amounts for all of your IRAs and withdraw that total from one IRA or a portion of each of your IRAs. You don't have to take a separate RMD from each IRA. Just a couple other things to note about RMDs. Generally, you can always withdraw more than the RMD amount. You just can't apply any excess withdrawals to any future RMDs. So I keep that in mind. And also, when you withdraw your annual RMD, you can do so in a number of distributions throughout the year, just as long as you withdraw the total annual minimum amount by December 31 or April 1 if it's your first RMD.
All right, got another question here. Is there an easy way to determine if I should convert some of my traditional IRA into a Roth IRA?
Yeah, so we touched base a little bit earlier in this presentation about timing. So if you're considering converting traditional IRAs to Roth, typically, again, you'll do this in when your income is lower than normal. So hopefully you have some cushion in your income tax brackets to stay within that lower tax rate. But again, when you're in a lower tax bracket than you anticipate being in retirement, or you expect tax rates to be higher in the future, those are great times to start thinking about and considering this. One of the pieces that we had mentioned earlier, and I'll just reiterate, is that one of the drawbacks to a Roth conversion is that immediate tax liability. So you'll want to have the funds available to cover the tax on that conversion at that time. But there are really great tax projection calculators, tax planning tools available to help model this type of scenario. So again, just reach out to your financial advisor and your tax advisor to help build these illustrations for you. I know in my practice, I help clients do this every year, multiple times in multiple scenarios as well. So it's common, very common.
Okay, probably only got time for a couple more questions here. What are the tax pros and cons for retirees doing Roth conversions in their 70s or 80s?
Pros, well, in general, plus sides again with a Roth is the future tax-free withdrawals and the tax-free income on retirement, RMDs. The Roth IRAs also don't have RMDs at all. So Roth conversions, if you wait until your 70s or 80s, one thing it can do is reduce your future RMDs and reduce your taxable income down the road. So that too can potentially lower your taxes on Social Security and avoiding that higher Medicare premium that comes up. The con of waiting till your 70s or 80s to do this, for anyone doing a Roth conversion, again, it's that immediate tax bill. But a conversion does it could put you into a higher tax bracket. So you'll have to be prepared for that tax liability. So it's really crucial to evaluate that immediate tax hit and outweigh it with the potential long-term benefits. So for example, converting that really large sum of money to a Roth, it could temporarily increase your income and then trigger higher Medicare premiums due to they have a look back period to use to calculate your income adjustments and get to what premium you're going to pay. So always have to remind clients of that look back period for Medicare premiums. The other drawback at an older age, you have a shorter time horizon to benefit from that tax-free growth of a Roth IRA. So it kind of makes the conversion less advantageous.
All right, let's end it with what I think is going to be a softball here. What is the deadline for a Roth conversion?
The deadline for completing a Roth conversion is December 31 of that current tax year. So unlike Roth contributions, you have until the tax filing deadline. The Roth conversions, they have to occur by year end to count towards that tax return.
All right, well, again, I think that's going to be about it for the questions we've got time for. Thank you again, Angelica, for joining us today. And I want to thank everybody else for attending today's webinar. Again, look for that replay in your inbox or check out our YouTube channel. We've got lots of other webinar replays there and lots of other informative videos for you to check out. So with that, thanks again, and we'll see you guys the next one. Take care.